Now I've got Mayuresh Joshi from Angel joining us, and before we go to all the news and get his comments on that, Mayuresh, let me start by asking you about poised in the midst of earnings season. Even a number like the one that Axis posted didn't quite spook the market. We did accumulate. My question to you is that is this pretty much going to be the base from which we're going to climb higher? But though the futures and options indicates a capping at about 8,100. What is your own sense?
Afternoon, Mini. I think time and again we have discussed the entire issue of re-rating for the Indian markets will come on two factors. A, in terms of how earnings will pan out. And again, I think the earnings are expected to be soft. I mean, if you leave aside a few numbers which have come so far, which have been encouraging in terms of what estimates were being laid out, our own take is that the earnings recovery will start happening by the second half of this fiscal. And that should lead to some amount of respite in terms of re-rating and valuations that the markets might look forward to in terms of core earnings. Secondly, I think the kind of capex that one really expects, specifically on the private side, to come through, I think the government spending is expected to be very, very robust. If that is followed by good monsoons, as one really expects for this year around, we're probably expecting rural spending to go up. With that spending going up, a large part of the rural discretionary incomes we will see a fillip, which will create a lot of tailwinds for a lot of FMCG companies, consumer durable stocks, and that will have a telling effect in terms of how the economy might move FY17, FY18 onwards. So I think these 2-3 factors, along with reform processes and obviously global volatility, will keep the markets in check from a short to medium term perspective. The long-term prospects, in our opinion, with nominal growth expected at 12%, our own take is it should revert to mean in terms of earnings coming back at 15-16, but one must wait for a couple of quarters for those earnings to show signs of revival.
Are you watching out for what the Fed does? Because the consensus seems to be that there is not going to be a rate hike till at least a year and a half down the line. But are the markets watching at all what the Fed does today or says?
No, today's move, I think, largely is getting factored that nothing will happen from the Fed side, though I think the commentary will be a deciding factor going forward. And again, I think the Fed is dependent on a lot of these global macroeconomic indicators. What happens with China, what happens with the emerging pack, what happens with the commodities movement, what happens with crude, what the ECB does, how Britain is going to probably react in a couple of months' time, and if that Britain exit happens, what repercussions it happens in terms of both currencies as well as the trade movement happening specifically from that region. So I think there are a lot of data points to play around, at least from a global standpoint. So I don't think that the markets are gestating anything happening from the Fed, at least in today's meeting. And what happens going forward is going to be largely data dependent. So I think the markets will be on the hinge specifically on how data points move, whether internally for the US markets in terms of how the labor market moves, how their housing starts move. But again, I think the global market picture as well is equally going to be important. So I think the equity markets worldwide are going to be very, very wild and choppy, at least from a short to medium term perspective, and they will react to all these macro data points as well as the micro developments happening within their own economy.
Oil has seen a sharp rebound, and I think the projections now are also a little higher for the year at 41. ONGC is done well. Mayuresh, how would you play ONGC right now?
ONGC has become a direct player in how crude price movement is going to happen now, Mini. So I think if crude reacts positively, ONGC is going to react positively. If crude falls for any unforeseen reasons or circumstances, the stock is going to see a nosedive. So again, I think in terms of their core capex, in terms of their production estimates for the current fiscal, it's largely getting built in, but with realizations probably dependent on how crude moves. I think the fortune in terms of earnings will be dependent on that factor. So in my opinion, I think the stock will be a market performer. It will move as the crude price movement will be, and that will largely determine the stock performance. But largely, I think I'm not expecting any outperformance from ONGC, at least for this fiscal, considering that crude is expected to be staying in a range.
Fair enough. Meanwhile, Yes Bank has posted a stable fourth quarter. Profits are in line with estimates, while NPA see a slight increase. My colleague Shraddha Babla is here with the numbers and what the highlights are. Shraddha.
Yes, it's been a robust performance from Yes Bank, just as expected, absolutely in line sort of numbers. And even if you look at the operating metrics, all of them are pretty stable on a Q-on-Q basis. So, strong net interest income growth of 27%, profit growth of 20%, 27% again in line with what we were expecting. Net interest margins also stable on a Q-on-Q basis at 3.4%. Strong loan growth of 30% versus the 25% sort of a number that we were expecting. When it comes to asset quality, there's been a small uptick on a Q-on-Q basis, 10 basis points bump up in the GNPA ratio to 0.76%, but still remaining below that 0.8% mark. There was no SDR or 5/25 refinancing for the year. In fact, the management has been able to meet its FY16 guidance for credit cost of 50 basis points. Nevertheless, FY17 guidance has been raised slightly to 70 basis points, but overall asset has been stable, and in fact the management also said that do not anticipate any material slippages to come into the book going into next year. In fact, the entire impact of RBI EQR has also been taken during the quarter. Additionally, the board has approved fundraising up to 10,000 crores via debt and raising about $1 billion via equity capital issue. So overall stable in line quarter just as expected from Yes Bank.
Right. We also heard Rana Kapoor, and this is what he had to say on the operating metrics.
Yes Bank has demonstrated, not just over this last one quarter, last 1 year, as most of you know, that the global crisis which started in March 2008, so 8 years ago, right, 32 quarters ago, right, has resulted in our bank in a way proving quarter on quarter sequentially that overall asset quality has been preserved despite headwinds, exogenous and domestic.
Meanwhile, of course, Axis Bank has cracked in trade. It was a stable quarter, but the market got spooked by the management commentary that asset quality may worsen in FY17. Shraddha is still with us, and she's here to take us through the major worries for the bank.
Well, yes, in terms of the key management takeaways, yesterday the management did say that the total loans under watch list for NPAs for Axis Bank stand at 22,600 crores. In fact, the management said that they expect 60% of this watch list to turn into NPAs over the next 2 years. So we could expect slippages of close to 13,500 crores versus 5,300 crores that we saw in FY16. So more than doubling of that. 70% of the restructured or SDR cases and about 25% of the exposures to the large leveraged corporate have been identified as a part of their watch list, but the management did say that they plan to build 70% coverage on these loans. They've said that 45% of the stressed loans are actually coming from the iron and steel and the power sector. And they've guided for a credit cost in the range of 125 basis points compared to 111 basis points in FY16. In fact, in case of adverse situation, they said that the credit cost could also rise to as much as 150 basis points. So these additional credit costs and revenue leakage has led to some earnings estimate cuts that we are actually seeing. So in terms of what brokerages have to say, we have CLSA, they've cut their earnings estimates by 12 to 15% for FY17-18 on account of the higher credit costs. Nevertheless, they have maintained their buy and in fact even gone ahead and increased their target price from 520 to 575. Bank of America Merrill Lynch also has gone ahead and cut their EPS targets by 8% and 7% for FY17 and 18. They believe that the stress assets may peak out only in the second half of FY17. Nevertheless, they also continue to reiterate their buy and the target price of 560 that they have. Kotak, again, we have them maintaining their buy rating on the stock. They've marginally cut their target price from 540 to 530, given that 13% of the corporate assets for Axis Bank is under active monitoring. So overall earning estimates being cut, but outlook being maintained as far as Axis Bank is concerned.
Right, Shraddha, thanks so much. Then this is a quick take from the management as well on the asset quality outlook.
I think some of the initiatives taken by the government are clearly helping at the operating level. One can clearly see EBITDA margins of some of these institutions get a lot better than they have been before. However, it will take time for that to flow through into repayment ability and for that to flow through into asset quality improvements. So for now, we continue to remain very cautious about asset quality, particularly in the corporate lending space.
Well, I've got Mayuresh still with us. Mayuresh, I'm going to ask you what you made of the bank level numbers because Yes Bank was very, very surprising on the fact that they have been able to manage their asset quality in a market like this. And Axis, clear indication that the worst is not over and that the provisioning is going to continue. So the book really looking very stressed right now.
Well, yes, absolutely, and two divergent results coming through, Mini. But largely, I think if you look at Axis Bank's numbers and the kind of disclosures that the bank has made specifically towards the stressed out sectors, specifically towards the funded exposure towards highly leveraged groups, I think it's a very encouraging part to understand that whatever amount they are talking, 22,800 odd crores, that should rather be the bottom in terms of what might come through over the next 8 quarters. Yes, that will have a telling effect in terms of how their profitability will move. But again, I think the management is very, very clear that I think it has recognized upfront what might go under stress. The credit costs are expected to go higher. The earnings estimates have already got cut. So any positive surprises in the second half, if credit growth resumes in the system, if the end working capital constraints that a lot of the end user industries are facing comes down, I think these assets might not get recognized. So clearly, I think Axis Bank is something that I'm very, very optimistic about if you're a long-term investor. For Yes Bank, again, I think the asset quality a little bit under pressure, with fresh slippage at 329 odd crores coming through for this quarter. But again, I think the management commentary revolving around how the retail deposit growth has been, along with the accretion in the CASA ratio, that is probably enabling the bank to post a decent NIMs, and that itself will have a greater synergies in terms of how their operating leverage benefits will play out. So yes, in absolute terms, I think the asset quality might have slipped a little bit for Yes Bank, but more realistically, if you talk about a 2-year time frame, with CASA ratios going up, with the part of the retail franchise going up, with retail advances growing at a much faster pace, the operating leverage benefits and the return ratio should improve. However, I think valuations at 2.4 times price to book appear as a headwind for the stock at the current moment.
Right, that's a snapshot of banking and some of the big numbers over there. Let's move to telecom. Bharti Airtel likely to dial in a stable Q4. India revenue expected to see a bump up while ARPUs are seen steady. Piyush Jain joins us with a preview of what the street is expecting. Piyush, Infotel's numbers are very good. What is Bharti Airtel expected to post?
So in the results, the street will be looking at two numbers very closely. One is the revenue growth, which is expected to grow by around 8%, and the second would be the EBITDA margin. EBITDA margin basically is expected to decline by 60 basis points, and that is primarily estimated on a moderation in the Infotel margins. And mind you, like the Infotel basically was a beat on margins, so perhaps there is a chance of positive beat from Bharti Airtel also. But then let's remember what will be the key factors to watch out for. There will be 3 factors. One is the data ARPUs. Data ARPUs have been on surge over the last couple of quarters, and that has been a main reason for Bharti's improvement in the performance. Data ARPU was around 200 in the last quarter. Overall consolidated ARPUs were around 192, have dipped from 200 from a couple of quarters. So I think ARPU should be the number 1 factor to watch out for. Number 2 is, since Bangladesh operations have been sorted out, basically a watch on the underlying performance on Africa operations would be a factor to watch out for. Last quarter was a beat on the core operations in Africa. Again, this quarter, if performance improves, it will be a positive factor for Bharti. Number 3 would be how basically the India wireless business is doing. The wireless traffic growth basically should be a very key factor. 4G rollout is happening. There is a lot of migration from 3G to 4G. So how the volumes are shaping up for Bharti would be a key determinant in terms of what is the return on business and also on the margins. In the last, basically, Bharti is also expected to contemplate on final dividend or basically buyback announcement. So like Infotel announced, perhaps Bharti Airtel could also give an attractive buyback announcement for the investors. So all in all, also, the last but not the least, the capex, Bharti is undergoing around 60,000 crore of capex program of network optimization. So any update on that and how they're progressing on it would be an interesting event to watch out for.
Right, that's a quick snapshot of Bharti Airtel. Let me get Mayuresh in here. Mayuresh, I'm going to ask you, what do you make of the Bharti numbers? And what is the one thing that you'd watch out, saying that the street is going to possibly look at re-rating the stock on the basis of that, if at all?
Well, largely as Piyush mentioned, Mini, the voice traffic is expected to be slow and muted what happens with the voice ARPMs is going to be equally critical, specifically when it comes to the Indian operations. And our own take is that the voice ARPM should be anywhere between 34 to 35 odd paise, with EBITDA margins between 37.5 to 38.5% for the Indian operations. The African operations are equally important for Bharati. The margins there of the kind of revenue growth that one really expects, and the management vision in terms of what they're looking at in terms of African operations is going to be pretty key and pertinent. But I think larger point here would be the kind of capex that Bharati would be doing in the coming year to probably take on competition from Reliance Jio whenever it launches. And with the kind of acquisitions that they've done, with the additional spectrum of 700 that's expected to come through, and what are the base prices we are talking about at this point of time, what kind of toll does it give to its already leveraged balance sheet? Net debt to annualized EBITDA already is very, very, very high, and that again will have a huge amount of saying in terms of how the cash flows for the company will move. So I think all these factors are going to be equally important to be watched out for when Bharti declares its numbers later today.
About the buyback, what is the expectation? Of course, this whole dividend buyback play that is happening ahead of the tax changes, etc. But should a company with high leverage be looking at a buyback? Mayuresh, as an analyst, what would you say to that?
So largely depends on the management on what they intend to do. But again, I think I'm not in favor of companies which are having high leverage to probably just focus on their core operations and get their debt level down. But again, I think in a telecom space and in a space like telecom, I think you just need to do this capex. I think the capex basically comes on two counts: A, on spectrum payouts, which is not an annual exercise, but that exercise probably takes a huge toll in terms of future cash flows. And secondly, I think the maintenance capex. So what a lot of these operators are doing is they need to overhaul their network in a very significant manner, and that will have a telling effect in terms of what costs they probably incur towards their tower business, towards replacing their old redundant equipment, and that keeps on happening on an annualized basis. So I think the cash flows that they generate from their core operations, specifically in terms of margin accretive operations like data, I think they're probably used in capex programs. I think that will have a telling effect in terms of return ratios. I mean, I'm not really sure on how this whole buyback program is going to pan out.
Fair enough. Of course, moving now to the pharmaceutical and biopharmaceutical space, Biocon posted a steady set of numbers with an exceptional gain boosting the numbers. This is what Kiran Mazumdar-Shaw had to say on growth triggers for the company.
The product rationalization is mostly complete now, and that's why you're seeing such a flat performance in the branded formulations business, because we've shed a large number of brands. We are now focusing on our diabetology, oncology, nephrology and immunology areas in a very specialized way, and I think going forward you will now start seeing growth from this baseline.
Right, Biocon giving out great numbers. Mayuresh, how do you like the stock in terms of valuation and the whole Syngene play, which has to be looked at in both dimensions?
So Biocon largely again, I mean, if you adjust for the one-offs, I think the profitability again more or less in line with what they did last year. Secondly, I think one needs to really understand that the biopharma business, which accounts for a chunk of Biocon's revenues in excess of 50 to 54 odd %, I think it is facing some amount of issues, both in terms of credit payments coming in from the Middle East, what happens with the Malaysian insurance operations and the capex there itself. Like the telecom sector, I think Biocon has a lot of capex to be done in terms of core facilities expected to come through, the maintenance capex, which is also expected to be pretty high, and what happens probably with their pipeline. So again, I think the return ratios have largely been subdued, and in my opinion, I think they will continue to remain subdued at least for the next few quarters. The performance in terms of stock price movement has been exceptional, so I think it's up to numbers in the coming quarters, which our belief is again is going to be a little bit subdued or below par if one really does a year-on-year or sequential check because of the capex programs, because of the huge R&D spend. For Syngene specifically, I think the revenue more or less in line with expectations for what I had built in. The EBITDA margin is a little bit disappointing, but again the management is hopeful for the kind of clinical trials that they've got in higher single digits. If they start getting monetized, the milestone payments, if they start coming through, I think all this depends upon the entire complex business structure that Syngene moves out of. And again, I think it is dependent on what the end user client probably has in terms of delivery of those molecules given and the end product realization. So I think there are a lot of risk factors involved. with syngenes and product realizations as well. So I think investors should keep these points and factors into consideration before investing.
Fair enough. The other big news that the market is awaiting is the bailout of one of JSPL's plants. Sajjan and Naveen Jindal are all set to ink the deal for the 1,000 megawatt Chhattisgarh plant. Reports indicate that the boards of both companies will meet today to approve the deal. As we had reported last Friday, the deal may involve multiple phases and takeover of Jindal Power's debt by JSW. My colleague Pranoy is here with the deal contours. Pranoy, it's been the most anticipated deal, but obviously not a very easy deal to pull through because of the multiple layers at which it is being done.
Well, absolutely, and we understand from sources, incidentally, I mean, we got this to you first, and it's a reaffirmation of that, of course, but sources tell us that it is likely to be in tranches and in several levels. So the first level entails JSW taking up 4,000 crores of JPL's debt on the books, and they are in talks with the lenders for the Chhattisgarh facility. About the plant itself, this has been a pedigree plant and broke even really fast, and the realizations were good, especially for the initial 1,000 megawatt, which is being considered at this point. The overall capacity is 3,400 megawatt, 2,400 is brownfield, under expansion right now. One or two concerns that can really be worrisome for the valuations happen to be that the incremental PPAs, those have to be completely in place for there to be a vent in terms of the generation revenues to come in, as also something like the surety of captive coal, which has been a big strain as far as the cost component is concerned, because captive coal will be, of course, the cheapest, and Tara and Gare Palma were the two blocks which were there. They had won it at really subdued prices relative to their other power peers. 106, 108 per ton for Gare Palma, 126 per ton for Tara, if memory serves me right. And there were outliers in that sense. So the matters pertaining to these blocks is still sub judice, and they do not have custodian rights for this, JSPL for Tamnar. So these are a couple of issues, niggling worries that can strain valuations. Just a crude barometer to compare this with the previous deal that happened in the thermal power space was struck between JSW Energy and JP Associates' Bina asset, thermal asset in Madhya Pradesh. That was struck at a valuation of close to 7 to 7.2 crores. Of course, that's on the higher end, so we are not expecting somewhere close to that, given the kind of reasons and the hurdles that are there as far as these valuations go. But most certainly, it will be a positive for JSPL, given the strained pressure that it is seeing on its P&L in terms of debt servicing and interest servicing, which has been high for the last several quarters, and given the kind of strain that the steel business is going through specifically. For JSW, this makes complete sense because they already have their presence in South India via their Vijayanagar plant in Maharashtra, as also in Ratnagiri, and in Gujarat, Rajasthan via Barmed. They have acquired the thermal assets in Madhya Pradesh from JP Associates, the hydro assets in Himachal. They are interested in Mone's assets in East, that's in Odisha, and now comes Jindal Power in the state of Chhattisgarh. So this pretty much gives them a pan-India footprint, especially in the thermal space. So it makes sense both ways, but the PPA signing as well as the captive surety for coal will be one or two factors that will be critical in the passage of this deal in the days to come as well.
Right. Mayuresh, I think Pranoy has brought different aspects of the deal contours and what is at stake for both the parties. From your standpoint, what does it indicate? I mean, because the last 4-5 months, the theme has been, the whole M&A activity, deals in the stressed asset side. And now, apart from this fact, you also have many global funds which are experts in stressed asset reconstruction coming in also to look at it. What are you making of this entire move?
Again, largely speculative at this point of time, unless it fructifies, and what kind of valuation, if it does fructify, it does come through. But again, I think JSPA's balance sheet is not encouraging at all at this point of many. Consolidated debt of around 48,000 crores. If you look at the power asset, I think the debt there is much lesser. But again, if you look at the kind of valuations that one really expects for them to come through, specifically in terms of their power assets, I think one really needs to wait and watch. And if you go by the precedents that Pranav was saying at this point of time, I think he's talking about the larger or the higher end in terms of what happened with JSW Energy and Bina. So again, largely speculative at this point of time, but if the deal does fructify at valuations, which will be very, very interesting to note at what valuations it happens, it does get the debt down for JSPL, it does improve their cash flows, and yes, JSPL has been under stress because I think the captive coal plants or the coal mines, which have probably got out with the surcharge that Supreme Court has also charged, I think that is taking a toll in terms of both the profitability and the cash flows for the company.
Right. Thanks, Mayuresh, for joining us with your take on all the stocks that are moving the markets. Lots to discuss over there, and we continue our discussion on the markets and put the spotlight on what's happening on the crude front. We will be talking to Azlan Ahmed of Argus Media. That's coming up for you in just a couple of minutes.